Hi Bursa Marketplace Facebook fans, welcome to Chit Chat Bursa Marketplace in the spotlight with Affin Huang Asset Management Berhad. My name is Chong Lee Chu and I'm the Director of Innovation Lab and Alternative Investment of Affin Huang Asset Management. Today, I'll be speaking to you about investing in ETFs. Whether you're new to investing or have been investing for a while now, making an investment decision can be a daunting task. And to make things worse, you can't help but to feel overwhelmed with the variety and range of products available out there. So in order to make an informed decision, it is important that you understand the product and its associated risk before investing. So in today's session, I will take you through very quickly generally about the basic of investing in ETFs, and on the latter part, I will be speaking to you and introducing to you a gold exchange traded fund that is available on Bursa Malaysia. Exchange traded funds, or ETFs, are commonly known as a hybrid product between a unit trust fund and a stock investment. And why is it so? It's because the exchange traded fund is managed by a fund manager, like a unit trust fund, and at the same time, it is traded on the stock exchange just like any ordinary shares. ETFs are usually passively managed and it tracks a specific index. Take for instance the FBM KLCI. We all know that the FBM KLCI comprises of the top 30 largest companies listed on Bursa Malaysia based on their market cap. And if an ETF is designed to track the performance of the FBM KLCI, then that would mean that the fund manager would be buying all 30 stocks in the index, and that gives you an instant diversification. So given that ETFs are generally a hybrid product between unit trust and shares, they share a lot in common with these two investment products. Firstly, from a diversification standpoint, ETFs, just like unit trust funds, gives you the diversification to a basket or portfolio of investments or stocks. Whereas if you invest in the shares, you get exposure to a single underlying. And when it comes to trading or buying and selling of ETFs, because it is very akin to shares, it trades like a normal shares, and prices are available throughout the day, intraday, and you typically buy it through your brokerage account that you maintain with your broker. Unlike a unit trust where you go through a unit trust agent and pricing are usually available at the end of the day. Settlement for stocks are the same as ETFs, where they settle on T+3, unlike a unit trust fund, where they settle on the spot, where you have to pay cash upfront prior to investing. From a liquidity standpoint, we all know that when you invest into a unit trust funds, the fund manager more or less assures that they will redeem, take back or buy back the units from you when you put in your redemption. Whereas for shares, if you would like to buy or sell, it is market driven and depends on supply and demand. This is a unique feature of ETFs where it has dual liquidity. And what do we mean by dual liquidity? It means that you get liquidity through both the primary market as well as the secondary market. So if you go through the primary market, you will have to go to a participating dealer, or PD in short, where the PD will then come to the fund manager to redeem the units just like a unit trust fund. Whereas if you go through the secondary market, it will depend on two things. Firstly is the supply and demand for the ETF units, and secondly is the prices that the market makers quote. In the next slide, I will illustrate to you how liquidity is important to you. And from a sales and charges or fees and charges perspective, unlike a unit trust fund where you typically pay a sales charge upfront, buying an ETF will incur brokerage fees just like shares. And as for management fee, if you pay management fee for the fund manager to manage your unit trust funds, same goes to ETF, that you will have to pay a management fee to the fund manager in order for them to manage this ETF. And essentially, ETFs generally has a lower management fee as compared to unit trust fund. So to sum up the benefits of investing in ETFs, firstly is diversification. By investing into a single product, you get an exposure instantly to a basket of shares or underlying. Secondly, it's transparent because an ETF issuer is obligated to announce the portfolio holdings of the fund or the ETF, so you essentially know what you own exactly. The flexibility, when buying and selling ETF shares, is flexible. You can buy it at any time during any day that the exchange is open. ETFs are liquid, which I will elaborate in the next slide, and it is cost efficient. So imagine if you were to buy all 30 stocks in the FBM KLCI, it would incur a very high transaction cost, as opposed to just buying a single ETF that tracks the 30 underlying. So we have come across many people asking about liquidity of ETFs, because ETFs in Malaysia at the moment is not very actively traded as compared to the developed markets. But does that mean that ETFs are not liquid? That's not true. If you have been investing in stocks, you would have been told that you need to gauge a stock liquidity through its traded or transacted volume. But this does not hold true for ETFs. That is because ETF issuers like ourselves are obligated to appoint a market maker to be there to constantly provide liquidity to investors in the secondary market. So what is important to gauge an ETF, whether it is liquid or not, should be the bid and offer volume. So let's take an example of this in this table that we've shown you, ETF A and ETF B. They both have the same bid and offer volume. However, ETF B has got a traded volume of 1 million units. Naturally, one would think that ETF B is actually more liquid than ETF A. But the truth of the matter is, they are just both as liquid. So now that you have understand a little bit about ETFs in general, today in Bursa Malaysia, there are 10 listed ETFs where you can actually invest in, and out of which 8 of them are equity ETFs, 1 fixed income ETF, and also a commodity ETF. So let me introduce you next to a product or the gold ETF, which is available on Bursa, that is managed by Affin Hwang Asset Management. It's called the Trade Plus Sharia Gold Tracker. This product was listed on Bursa Malaysia on the 6th of December 2017 with a stock code of 0828EA. And this gold ETF actually is designed to track the performance of gold price. So essentially, in order to track the performance of gold price, the fund manager will invest a minimum of 95% in physical gold, where the gold bars are actually held by our custodian, who is Standard Chartered Singapore. This gold ETF provides investors an avenue to own or access to physical gold in a hassle-free way, because you don't have to bother about where to store your gold and insure your gold, because it is all taken care by the fund or the fund manager. And last but not least, this ETF allows you to redeem physical gold if you actually have 500,000 units of the ETF shares. Now let us quickly take a look at the factors that could influence the gold ETF pricing. Essentially, the ETF pricing is quoted in ringgit that is traded on Bursa Malaysia, And there are two elements that will affect the price of this ETF. Firstly is the gold spot price in US dollar, and secondly is the US dollar versus the ringgit, or the currency exchange. So let's take a simple illustration. For instance, if the gold spot price in US dollar terms has appreciated by 5%, and if US dollar were to strengthen against the ringgit by 3%, that, put it simply, the ETF price in ringgit would appreciate by 8%. And let's take a look at another scenario. If gold spot price in US dollar term were to appreciate by 5%, and if the ringgit in turn appreciates against the US dollar by 6%, the ETF price in ringgit will decline by 1%. Of course, the illustration here is simple, and we have not taken into account the fees and expenses of the fund. So you may ask me then, what are the ways that we can invest in gold, and is investing in this gold ETF the most cost-efficient way? Now, first option that you have, or an investor would have, is to buy and hold physical gold. But as you can see, buying and holding physical gold may not be the best cost-efficient, may not be the cost-efficient way to enter or hold a position in gold, simply because of the wide bid and ask spread. So in this example that we have given to you, you would be buying gold at 210 ringgit, but when you sell this 1 gram of gold back to the gold bullion trader, they would only pay you 162 ringgit in return. So that would mean that instantly you would have gotten a 29% decline in your portfolio, or in your investment in gold. So that would mean that you will need gold to appreciate by 29% before you actually break even. Now, the second option is through a gold deposit or savings account. Today, many financial institutions in Malaysia offer this product to investors. They are quite, I must say that they are also very cost efficient, and they have a very low bid and ask spread, a lot better than buying and holding physical gold. It's roughly at about 4%. However, these products may or may not be physically backed by gold, and there are administration charges that applies that an investor should take note of. And last but not least, the Trade Plus Sharia Gold Tracker ETF, or the gold ETF, is an efficient way to gain exposure to gold, and it's physically backed. The bid and ask spread, because of the fact that we have market makers appointed behind this to provide liquidity, we can ensure that a tighter spread is being quoted. So typically, in a normal day, the bid and ask spread will range around somewhere between 0.5% to 2%. But of course, buying into this ETF would incur brokerage charges, and at the same time, the fund also charges an annual management fee. So in order to decide which option provides you with the best way to enter or access to gold, you will need to first look at or determine what is the amount of gold that you intend to buy, what is the tenure that you intend to hold this investment, and lastly, what are the transaction costs that you will incur in all this option before deciding which option is the best for you. Now, you may have noticed in the previous slide that when buying or trading the gold ETF, you would be paying slightly more than 1 gram of gold that is being quoted by a financial institution. But does this mean that you are buying gold at a higher price? The answer is no. This is because you will need to first take into account how much gold you are owning per 100 units. So in this example that we have given, say for example today, the fund holds about 206 kilogram of gold bars in the fund, and if we divide this with the total units in circulation, which is 20.1 million units, and you will get that per 100 units that you buy, you actually have a claim against 1.024875 grams of gold. and that explains why the ETF pricing is actually more expensive than buying a 1 gram of gold through your gold deposits account. So allow me to quickly run you through the reasons why one should be owning gold in your portfolio. There are just 3 key reasons before I end this presentation. Firstly, gold is an effective diversifier because it has a very low correlation with a lot of the other asset classes. And especially to equities, they tend to move in the opposite direction as illustrated on this chart on the left. So as you can see, especially during the bear markets, gold tends to move in the opposite direction as equities. So take the US subprime crisis, which is the latest crisis that happened in 2008, for instance. If you would have invested in the FBM KLCI, you would have obtained or achieved a negative 39.6% decline in your portfolio. But if you have a little bit of gold, your investments into gold would have given you a positive return of 21%. So gold, given its attribute of moving in the opposite direction of equities, makes it an effective hedge for your portfolio. And secondly, gold is a source of long-term returns. So even though gold moves in the opposite direction with equities, it doesn't mean that when equities are rallying, gold does not perform. So as you can see on the chart on your right-hand side, you will notice that if you hold gold for the long term, say 10 years, 20 years, or 30 years, gold gives you a positive return. And during certain times, it could be comparable to equities return. So it's important to have a diversified portfolio. And the third reason as to why you should consider owning gold in your portfolio is that gold is a means to enhance your overall portfolio performance. And what do we mean by that? If you look at the chart that we have plotted, you will see that the orange line actually represents a balanced portfolio, a mix of equities, bonds, and 10% in gold. If you look at the long-term returns of this balanced portfolio, you will realize that you do not need to invest 100% in equities to get equities-like return. So maintaining a balanced portfolio, a diversified portfolio, it can give you equity-like return, but with a lower risk and volatility. So this is why you should consider owning some gold in your portfolio. Now, as I end my presentation, I like to end it with an analogy. Investing in gold is like buying insurance for your house. So today, if you were to buy a fire insurance, you do not buy it expecting that a fire will break out, but instead, you buy it to mitigate a potential risk that could happen to you. So the same can be said for gold. Investing in gold is to mitigate, is not to say that something bad will happen, but it's a way or a means to mitigate a potential disaster or bear market that could strike, although you probably wouldn't want a bear market to strike. Now, I hope that this short session will be helpful to you, and it will help you in deciding if ETFs are a suitable investment for you. So thank you for tuning in to Chit Chat Bursa Marketplace in the Spotlight with Affin Huang Asset Management Berhad. If you have any further questions, please let us know in the comments section and we will get back to you. Again, thanks for watching, and for more Chit Chat Bursa Marketplace series, don't forget to like the Bursa Marketplace Facebook page. Thank you.